Ladies and gentlemen, welcome back to another video. I'm your host, TheDividendAristocrat, and if you guys have been keeping up with the channel, you'll know that I'm finally back. I have been sick for a little bit now, so I missed last week's upload, and I also missed Sunday's upload, but I'll be uploading this video on Monday if everything goes according to plan. Now, I still am fairly congested, and I hope you guys cannot hear that too badly through the microphone, but if it is obvious, I'm sorry about that, and hopefully by next week, I'll be back to normal. I was originally going to focus this week's video on my dividend income for the month of May, but I've been having some trouble with my spreadsheet recently, so I'm going to be doing a video on Johnson & Johnson, which is a dividend king that's near its 52-week low. Now, if you guys do enjoy these types of videos, definitely leave a like on the video. It helps me out a ton. If you haven't subscribed to the channel yet, please do so. I post weekly investing videos. Now, Johnson & Johnson is an American multinational pharmaceutical, biotechnology, and medical technologies corporation. It's headquartered out of New Brunswick, New Jersey. The company has definitely found its way into many investors' portfolio, and a lot of that is due to their good history of dividend growth as well as their consistent performance. As a reminder, this is not financial advice, and I'm just merely sharing my opinions on this channel. Now, as of late, their performance has not been as good, down over 6% year to date. And if we look at the year-to-date performance of the companies in the S&P 500, we can see it, they're ranking down there in the very high 300s. Currently, they're ranked exactly 386 out of 503 different companies, which is not great at all. Now, of course, taking a look at the bottom of this list, they're definitely nowhere near as bad as some of these companies, including Boeing, Walgreens, Intel, and Lululemon, which are down way over 30% year to date. Now, in the past year, their performance is not as bad, down 5.41%, which again, if it's not positive, it's not great, that's for sure. But if we look at their 52-week range, it does put them very close to their 52-week low, which is $143.13. Tracking their stock price a little bit, we can see that back in August of 2023, the stock price was sitting at a nice $173 per share. And then fast forward to November or October of 2023, we can see that it's sitting down at $148 per share. Since then, it did have a pretty decent increase, going all the way up to about $160 per share. But right now, where we're sitting currently, it's sitting pretty low at $146.67. So this might be a good opportunity to buy if you're just looking for a bit of a discount based on previous prices. Now, in terms of the performance for the past 5 years, it's only up 11.83%, but I do want to remind you guys that it does not include reinvesting dividends. The dividend yield is a little bit higher at 3.38% compared to a lot of other companies, so it's definitely going to contribute to their total return over time, but still 11.83% is pretty slow growth. And if you do take a look at the past 10 years, we can see that's up 42%, which again is pretty slow growth, kind of comparable to companies like Coca-Cola. Now, I personally don't own Johnson & Johnson in my portfolio because the companies that I do look for are a little bit faster growing than this. So Johnson & Johnson goes a little bit too slow for me. I have a longer time horizon, and I think the total return that I would get from a company like this is just not quite high enough. Now, there is still a case to be made about why some person might want to invest in Johnson & Johnson, especially at these current prices. You know, if you're looking more for wealth management or slower growth for stability in your portfolio, this company definitely does offer that historically. As we'll take a look at in a little bit, their dividend has grown very consistently over time, and their return has been consistent as well, just not growing too fast one way or the other. I think both the upside and the downside are limited with this company, and I don't think it's going to experience the same kind of decline like Pfizer has, but the industry where it's competing against, like the healthcare industry, especially the pharmaceutical industry, is a little bit more risky because it is dependent on if they're able to sell their products or not. Now, jumping into their financials, I think this kind of gives a good idea of why the company has not grown too quickly. If we look at the revenue, it's been pretty stable over time for the most part. January 2021, it was sitting at about $82 billion worth of revenue. And fast forward to now, it's about $85 billion, which is not too quick of an increase at all. As we'd expect over time, the R&D expenses are increasing, and that's also including their CapEx expenses. Now, their earnings per share do paint a slightly different picture, and it looks pretty good. And one thing it does take into account, of course, is their share buybacks. And if we look at their basic weighted average shares outstanding, we can see that over time this has decreased, which is very good for the company. Especially at a time where a stock price is decreasing, I'd like to see management making share buybacks more aggressively because definitely helps the individual shareholder gain more equity within the company. And in return, the earnings per share and other per share metrics will kind of increase by default. As I did mention before, their dividend per share has been increasing nicely over time. They've done a great job managing this. And what I do like to see actually is that their payout ratio has been decreasing over time, which is very healthy for the company. Taking a look at their long-term debt, they do actually hold a very large amount of debt relatively at $25 billion currently. But what I do like to see is that it has decreased very aggressively since 2022, back when it was sitting at $29.985 billion. However, if we do take a look at their net debt, we can see that it's actually covered nicely by a lot of their cash and cash equivalents, their liquid assets. So it's currently sitting at about $7.5 billion in December of 2023 for net debt, which is nowhere near as bad as their, of course, total debt. As I mentioned earlier, their capex is increasing over time. That's to be expected with any of these big companies, especially in the pharmaceutical industry. You do have to invest back into research and development, of course, to create new drugs or any sort of products you'd want to sell. Not only that, but building any sort of facility, whether it's a manufacturing facility, a research facility, or a distribution facility, is going to cost a lot of money for the company. But capex can kind of be seen as an investment back into the company, so it's not always the worst kind of investment. Now, real quick, the last financial metric I want to take a look at before I put you guys to sleep is their free cash flow per share. I think it's a very important metric to look at for these kinds of big, strong companies. And as we can see right here, it's been pretty consistent, pretty steady over time. Now, of course, I would prefer to see this increasing aggressively over time, but you can't always expect that from every company. And the fact that it has remained consistent is still pretty healthy. Now, here's the main reason people invest in Johnson & Johnson. It is their dividend history. So if we look right here, we can see they have 61 years of consecutive dividend growth, which is fantastic, and it puts them as a dividend king. Now, in the past 5 years, their growth rate has averaged about 5.67%, which is very good, especially for a company of this size that has been paying out a dividend for so long. It's definitely keeping up with inflation and actually outpacing inflation by a decent margin. According to Seeking Alpha, their pay ratio is sitting at about 45.51%, which is pretty healthy. I like to see it under 50%, which is great. And their dividend yield is currently sitting at 3.38%, which is pretty good as well. Now, for my personal portfolio, I prefer to have dividend yields lower than 2%. I just think that it kind of gives a little bit more room for actual growth of the company, but 3.38% is still in that healthy range where I'd be comfortable investing in something like that. Now, taking a quick look at its historical dividend yield, we can see that it peaked right here in 2020, sitting about 3.42%. And so currently you can buy for about as close as you could in the past, 5 years. Right now it's sitting at 3.28%. Going off of just dividend yield theory, we could see that there's maybe signs of slight undervaluation in the company based on dividend yield theory, since the yield is sitting much higher than its historical average in the past 5 years. Now, of course, it's not the only reason to invest in such a company. You have to do your research before investing, but if you are looking to jump to this company regardless, this would be a good starting yield compared to what you could have gotten it for in the past 3 to 4 years. And a cool visual to look at here is their dividend history. We can see that even on this max time frame, the dividend has been increasing every single year very consistently, and it actually does cap out, I think, like 1988. But if you were to go further back, you of course would actually see even longer history of dividend growth. It just isn't captured in Seeking Alpha. Now, in terms of valuation, they are sitting pretty nicely at a price to earnings ratio of 14, which is not too bad at all. And if we compare that to their 5-year average, they're actually down, 17% from their 5-year average price to earnings ratio. As a reminder, just because a stock's price to earnings ratio is lower than its 5-year average doesn't actually mean that's necessarily undervalued. It just depends on, investor sentiment and how the company is projected to continue doing in the future. Looking at their growth stats, we can see their year-over-year growth was actually pretty nice at 11%, which is very good. But looking forward, it's expected to be minus 1.47%, so a bit of a decline in terms of their revenue growth, which is definitely not a good sign. A lot of companies are going to be cyclical like this, especially in this sort of industry, so it might not be the biggest deal. A lot of this stuff is usually priced into the company's stock price, but again, definitely something to consider going forward. Looking real quick at profitability, we can see their gross profit margin is pretty nice at around 70%, which is pretty solid, and difference to the 5-year average is not that big. Usually they do sit at this consistent, nice and high profit margin of around 70%. Now, I do want to take the time to graph this company versus the S&P 500 for the past 1, 3, and 5 years, just to show you guys, maybe different investing options. In the past year, it's trailing the S&P 500 by a lot because it's down 5.4%, whereas the S&P 500 is up 26%. And if you look at the past 3 years, we can see the same kind of pattern. Johnson & Johnson is down 11.39%, whereas S&P 500 is up 25.6%. Zooming out and looking at the 5-year time frame, we can see kind of a flipped image where Johnson & Johnson's up 11% instead of negative 11%. But again, S&P 500 is outperforming it by a very wide margin, up 91%. Now, if we wanted to look at the total return of Johnson & Johnson as well, we can see it's a little bit better, up 28%. But again, this is not too significant performance. The reason you buy this company would be more for like wealth management and dividend income rather than total return itself. I think for many people that are just looking for total return over dividend income, investing in a broader market, S&P 500 index fund or ETF would be a better option than investing in just Johnson & Johnson by itself. Now, one argument that could be made is that Johnson & Johnson might be a little bit undervalued right now, whereas the market is overvalued. So if you bought it, towards the bottom, which of course you can never actually guess when that's going to happen, you might have some good price appreciation just from that as the multiple, the PE expansion occurs. In that time, maybe the S&P 500 would kind of decrease in price. So if you would have bought Johnson & Johnson, you would have a better opportunity, kind of better price appreciation just for that short amount of time. But I think in the long run, the S&P 500 will be outperforming Johnson & Johnson. As always, that does bring us to the end of today's video. I really hope you guys enjoyed this deep dive into Johnson & Johnson. Definitely let me know in the comments below whether you're buying this company or not, or if you already hold this company in your portfolio. If you haven't yet subscribed to the channel, definitely do so. It helps me out a ton. And stay tuned for next week's video where I'll go over my dividend income for the month of May. If you do want to see my video from last week and why I'm buying more as it dips down, check it out right here. And if you want to see my dividend income for the month of April, check out this video right here. Other than that, thanks again for watching and I will see you next week.